The last one or highest level that I'm capable to coach you on is a level 3 risk. And this risk level uses leverage to your benefit and does what the banks do with your money anyways. And think about way back when you're a saver or preserver and you put your money in the bank, this is what you're going to be able to learn how to do. So the banks lend out your money you save to others that know and understand how to use this leverage to their advantage. And we'll give you this archetype name, the leverager, which is really just a fancy term for saying that you borrow money that you don't have, either from a bank or line of credit, and you use that money that isn't originally yours to invest or / trade and build your pot of money quicker using someone else's money. When you think about this, it's the most effective way to create money when you don't have any. But just by the act of doing this technique, you need to be capable of understanding your risks as the risk increases for when you have a loss. This concept might be most easily understood by relating it to how you borrow a mortgage for your house. This is for some people considered an investment on its own, and some are very clever enough to have multiple properties to rent to others as an investment. And the biggest advantage in Canada with this technique with leverage is that the interest accumulated on borrowed money used for an investment can be used to offset taxable income. So this leverage technique is used in tandem with the other techniques used in level 1 and 2. And this makes this a dual purpose strategy. One being you use the bank's money instead of your working income to create your wealth. And 2, being you save on the amount of income tax payable by offsetting or reducing your total net income. This makes it hard to properly estimate what kind of gains you can actually get using this strategy because it would depend on your income tax bracket and on how much you would actually pay. This strategy isn't necessarily for everyone, as you really only want to pay the interest on the loan and not any principal, as this allows you to use any spare cash on investment cash flow. So by paying interest only on the loan, you make your money go further. And the interest you pay on the loan is tax-free, and you will pay off the loan at any time with your earnings. As an example, if you can think of investing $100,000 capital, and let's say you earn 25% or $25,000 profit. If you leveraged your $100,000 and borrowed $300,000 on that capital at 25% return, you would get 3 times or $75,000. For this reason, we'll suggest that you get 3 to 10 times returns more than a level 2 risk would be. Once you know all this and how to manage your own portfolio with these concepts and techniques, you should be able to make considerably more than you would by paying someone else to manage your money for you. This is hopefully enough reason to convince you to why it is best to manage your own money.